In our last video, we looked at indices and just passively holding those and, seeing that they can outperform what actively managed funds are producing. The next question that usually comes to mind is, what is the best way to actually implement it? Just because you say these are indices, you start looking at the various indices that you have. There's a lot of them out there. There's a lot of different indices that you can follow. Um, you know, and so that's really the question. And so because at this point, it's no longer about, if you should invest this way, it's about how to do it well. And that usually comes down to three things. Number one, keeping fees low, using a strategy with high probability of success, and sticking with something that's backed by research. So in this video, I want to peel back the layers and look under the hood at a few of the most common options. So let's have a look at the different types of investment options that are available on the market today. Let's have a look at what the big people are doing, like the big financial firms are doing when people are looking at indices. And so let's just, showcase some of that, because they have a lot of people that are working in the background to dig into various types of research and to formulate various portfolios. And so, because there is a large volume of people that are invested into indices, things like BlackRock and Vanguard, they're huge types of firms, and they have indices as well as a lot of the other different types of firms out there. So let's have a look at that, and I'm going to dig into my screen here in a second. Let me just pull that up. So here we've got Vanguard. Now, Vanguard was actually one of the leaders in regards to putting out indices. And, Jack Bogle, he, simply said, when it comes to investing, why not own the whole haystack rather than trying to find the needle in the haystack? And, the research over the years has proven more and more the case for owning the whole market. And so there was really a huge influx, I would say, to investing as a result of that type of information. And so we can see here, with Vanguard, we've got retirement funds. They've got different types of investment options for retirement funds. They talk about the difference between an account and investments, really elementary stuff. But, they're talking about asset mixes here. And going down, you could see here that they have something called a target date fund. Now, this is really interesting because, most people, when you're investing, you're usually looking at something like, something for retirement. Usually a lot of people, when they first start investing, they're investing for, a lot of retirement goals, as well as maybe investing and saving for something in the short term, like a vehicle, or maybe they're going to buy something like a house and those types of things. And so usually, the long-term investments are what I like to look at, especially things that are, catered more towards retirement. Because even if I'm going to do something in, say, the next 15, 20 years that isn't retirement related, right? You have to think about it like being invested isn't necessarily subject to, what you're putting those dollars to. Basically, it's all about just growing financial assets. And so, the whole thing is just mathematical. And so when I look at something that's more long-term, that's mathematical. If I look at something that's short-term, that's mathematical as well too. But in the short term, right, the investments would look different than they would in the long term because we're changing the math here. But for retirement, so for long-term goals, I would say that all of that can relatively be bundled into the same sort of category. So getting back to this, what is it that they're doing? Well, if you go into Vanguard target retirement funds, again, all these links will be left down below. You can see here that they have lots of different types of retirement funds and lots of different types of targets. So someone like myself, I'd probably be looking at retirement at, say, 2050. And you can see here, this is the overview of what this is. And by the way, first I might want to explain what a target date retirement fund is. It's basically saying, okay, we're going to invest in various baskets of funds. And as somebody comes closer and closer to, say, their retirement, right, they want to be moving into safer and safer assets because, a portfolio can handle that risk and have that risk there in the beginning stages when you're accumulating, and it has a higher chance of going up in the long term, where in the short term, if you take a big hit where there's a lot of volatility, then it's really tough. And so what they do in these retirement funds is they have a balance between how much they have in stocks and how much they have in bonds, how much they have in international stocks. But we're going to dig into it. I'm going to show you what they have, because again, these are looking at portfolio compositions based on indices. So we can see here that this is the portfolio. I clicked on portfolio composition. And again, we've got a longer time frame here, right? Because we're looking at 2050. So you can see here that you've got basically 4 funds, 4 indices. Like, people have the ability to actually own these types of indices themselves. But, in this portfolio, what this is basically going to do is rebalance your portfolio for you as the years go on. So you don't even have to spend time, rebalancing anything. You just buy one fund for your retirement and that's it. And it basically lowers its risk as it gets closer to your retirement goals. So you can see here that, having these 4 different areas, like we've got, the U.S. stock market here, and then we've got the total international stock index here, and then we've got the total bond market here, and the international bond market, and that's it. 4 funds, very simple. Let's have a look at another firm. Let's look at what BlackRock has. They even have this tool here, which is kind of cool. I'll leave it down there. But need help choosing a life path portfolio. You click it. Well, I already put it in, 1987. There you go. Now you know my age. And I want to retire at 65. So I calculate that and I see, okay, it's a 2050. If I type in 1980 and I want to retire at 65, I can calculate it. It says, okay, do the 2045. And if you say, okay, you know what? I actually want to retire when I'm 60. And I was born in 1990, then you could calculate that and it'll show you, okay, do the 2050. It's basically looking at the time frames and saying, okay, if it's within this range, then this is kind of like, this is basically the path that you should take. Now, if you look at the holdings here, or the iShares 2050, the Life Path Target Date Fund. So I can look at the holdings here. Now, when you look at this, it might look like a bit more than what you would see with Vanguard. But if you actually dig into this, like if you actually break down the various areas that they're invested, and you can cross-compared them and you broke them down into categories, like you subcategorized everything into, like say large cap, mid cap, small cap, type investments, so like large companies, medium companies, small companies, you looked at bond markets, you would find that both of these investment portfolios are quite similar. And you would even find that the ratios are quite similar, like how much of a percentage they invest into bonds, how much of a percentage they're investing into stocks. Looking at the sliding scale, you can actually see, I'll show you, that you can actually see relatively what that would look like over the course of time. So if I go into this life path, this one here, I can see that as time goes on, bonds become less and less, stocks become less and less, and bonds will continue to grow. And so this is really interesting, right? Because if you're trying to invest and you're trying to basically create a portfolio, you can have something like a target date fund that you could track and follow. And, something like this versus something that's like an actively managed fund, you might be spending 1% to 3% to have somebody manage that portfolio, where, if you do something like a life path investment portfolio like this, you're looking at like 0.08 or 0.1%, sometimes up to 0.25, like if you get into like a robo-advisor. And so there's various types of options that you have available at your fingertips. So, and if you want to save on that slight percentage, you could basically follow and track what it is that they're doing and invest in all of those things yourself and rebalance once a year or rebalance every 3 months or a month or whatever it is that you want to use as an interval. And so it doesn't become super taxing or super daunting in order to invest. There's a lot of simple things that can be done. And when you look at what larger firms are doing, when you look at what, these bigger institutions are doing when they're doing indexing, like they've got a lot of that research behind them. As well, at Good Fruit Investors, we're digging into all that research. We're going with what common sense is showing. And we're trying to give that information out because I really believe that there's a lack of that out in the industry today. Now, I could go into like a robo-advisor as well too, and maybe I'll just show it quickly on the screen. Something like Betterment. You could see that, they've got, like a core fund here, and they've got performances here. Something like this, when you're looking at it, you're like, okay, well, what are the holdings or what is it that their strategy is? So you could dig into the information here and read it. It sounds very sophisticated and it sounds like they're doing a lot. And so again, you're paying a fee, right? Like you're going to pay, like, I think it's 0.25% for the Betterment fee. I personally don't use this. I manage it myself. I don't use target date funds. I just, rebalance myself. It's very simple to do. But you can see that, they mention things like, they're going to take advantage of things like tax loss harvesting. It's a cool thing, right? That you can do, where you're, selling for losses, for that tax benefit, right? And then, you're buying usually another investment to replace, what you've basically given up. That's essentially almost the same, just kind of like packaged in a different type of an investment. They've got the automated rebalancing, which is what you're doing when you do something like a target date fund. And another thing called like quantitative like optimization, which is really just without, this might sound a bit nerdy, but getting into like modern portfolio theory, with practical constraints and just like ongoing research updates layered in. So there's a lot of little nuanced things. It sounds complex, but it's still rooted in the same core idea, right? Own the market efficiently. That's it. Own market efficiently. So everybody's trying to do that. And at Good Fruit Investors, the whole point of what we've created this channel for is really how can we build in those efficiencies? How can we look at that kind of information and what should and shouldn't we be looking at in regards to getting into those various types of investors? And so when you zoom out and you start to look at, what all of these different types of firms are doing, when you look at what robo-advisors are doing, when you look at what the research is telling you, you can see that, there's a general theme that's going on here. You can see that there's a general way that people are investing. So they're built on very similar foundations. And so, they use, low cost ETFs, right? They diversify globally and they balance stocks and bonds based on risk. And because of that, right, their performance ends up being very similar over time. You might have a slight advantage with one over the other, and you might have a reason why you would value one over the other. And again, that's why, we have this free will nature where you can make those choices and you can decide which path is better for you. Some people, like the idea of just clicking a button and buying one investment and having something like a target date fund, and that's all they have to ever worry about. Where other people don't mind doing a bit of rebalancing, or maybe somebody doesn't even believe in all of this and they don't care about it and they don't care about, the research that's out there, and they think that actively managed funds are better. And they can do that as well too, or, whatever. But basically, as an investor, you really have to start digging in and navigating that space. And at Good Fruit Investors, the whole point is we're wanting to do that together. We want to do that with you. We've got a community space for that. If you want to check out our website, I'll leave a link down below. But essentially, if you want to follow along, subscribe to the channel, watch for more videos that are coming out. We're going to dig into a lot more information, and we hope to see you at the next one. Take care.